All right, so we are back on. So if you missed the other section, we weren't able to share screen properly. So we are switching now over to a different platform so that I can share screen because, otherwise you're going to be looking at my face for 30 minutes, which is fine, except that you're not going to get the content of the spreadsheet. So let me share with you the spreadsheet and we will go right into it. Okay, so here we go. So this is the Excel spreadsheet that I like to use when I am calculating mortgages. So there's this sheet, and I also like to use this one here that I built out using the CMHC sheet that I got years ago. So I like using this one because it sort of gives me a quick overview of things. So we're going to talk about one change, which is increasing the amortization. And like when I started in real estate, the amortization was 20 years. And now we're seeing amortizations of 30 to 50 years, depending on the asset class that you're buying. And so it does make a difference in your numbers, right? So we're going to touch base on that, the increase of amortization. And the second thing we're going to touch base on is, what does a 15 basis point savings mean to you as an investor or a homeowner? Right. And that 15 basis point translate to 15%. Right. And, I was really interested to find out that when you switch lenders, when you switch the person that you're getting the loan from, usually you save about a 15% or 15 basis points. And I was like, oh, well, that's interesting because we all love to save. But what does that 15 actually mean? And is it even worth the effort of changing? Okay, so let's just touch base on the amortization first, because that's an easier concept to understand. So when you increase your amortization, it just basically means that you're going to take longer to pay your loan back. Okay, so I'm just running an example here of getting a mortgage for $800,000. Your mortgage, the interest rate is 5%. And we just started this in September of 2021. Okay, so it doesn't really matter what time frame you start. It's going to be 30 years from that point on. Okay, we're going to do a 5-year term, and we're basically just going to calculate interest payments, principal payments, and what that actually means for us in terms of a 30-year amortization. So I'm going to go back and change this to 25 years. So basically what that does is that it's going to mean that you have to pay your mortgage off 100%, pay it off in 25 years. Okay. So what that means is your monthly payment is $4,652. Okay. So I'm just going to put that number over. I'm going to make this bigger because I know some people are asking me to always make the screens bigger. So I'm just going to put that number up here just so that you could see this number and we can calculate what that actually means. So 84. Okay. So $4,652 is what your monthly payment's going to be. Okay. And this is at 25 years. Now, the interesting thing is now the interest that you paid on your 5-year term, because you're going to lock in for 5 years, and I'm assuming you're locking in for 5 years. With the rates going down right now, you may want to sign up for a variable and just sort of ride the rates down until it sort of plateaus. Okay, that's a completely different conversation because there's strategy and risks with that. So the interesting thing here is to look at your interest payment here, which is the 187,230.44. Okay, so I'm just going to put that number there. So this right now is for the 25-year M. Okay, so I'm just putting that up there. And your outstanding balance is, 708,000, which is fine. And the total interest that you would have paid in, until the very end is 526. Now, this number will change because after your 5 years, you're going to renew and potentially be higher or lower in your rates. You may sign up for a 3-year AM, so you may change your monthly payments to bi-weekly or weekly. So there's a lot of factors on that. So let's just look at these two. Okay, so your monthly payment is 6,600 and your total interest that you paid is 187 after the 5 years. Okay, so now let's run the numbers and say, okay, let's say we go from 25 years to 30 years. So you're buying a brand new property and the bank's offering you a 30-year amortization. What does that actually mean? Okay, so now look at this. So I'm going to put 30-year am here. Okay, so what happens now is your monthly payments go down to 4,269.53. So 4,269. Okay, so this is great because it means that you actually won't have to spend as much money every single month to make your mortgage payments. So the great thing about this is that it makes getting into real estate, buying your first property, buying your second, potentially a lot more affordable because there is, let's see, what's the monthly reduction here? About $383 less in expenses. Okay. Now, this 383 doesn't mean that you don't have to pay it. You have to pay that back at some point because you're still taking out a mortgage of 800,000. So you still have to pay it back. It's just that the banks are giving you a longer time period to pay that back. So it's not free money. Okay. So now the other thing to keep in mind is that now instead of paying 187,000 in interest in 5 years, you're now going to be paying 190,000. Okay, so this 192.65.18. Okay, so if you do the quick math there, okay, oh, sorry, I'm gonna undo that one. Okay, do the quick math there. Okay, it's costing you $3,000 in 5 years to be able to have a reduced payment. Okay, let that sink in a little bit. Okay, this $383 is not free money. The banks are not being nice to you by saying, hey, Mr. Borrower, hey, first-time home buyer, or hey, Mr. Investor, we're going to give you more time to pay it off. You know, it's actually in their benefit because they're making $3,000 extra on you. And think about all the mortgages that they have to fund. So they're getting an extra $3,000 from every single family that's coming on board. Think about the scalability on that. That's massive profits for the bank. Okay. So even though it seems like they're doing you a favor, at the end of the day, it's actually costing you quite a bit of money. So just keep that in mind. So now there are strategies to reduce this potential increase in interest that you have to pay to the bank. But keep in mind that if you're not aggressive on paying off your mortgage, it's actually going to cost you way more to pay off your mortgage. Okay, so one of the things that we talked about here is this in this interest amount. Okay, so I'm just going to put this 566,234 over here so you can see what the effect is. We're going to go back to 25 years. Okay, so look at the difference here between the 526,000 to 56,000. Okay, so let's do the quick math here. We're going to take the 56,000 minus, no, 566,000 minus your 526,000. That's 40,000 extra that you're paying to the bank just so that they can give you that extra 5 years to pay down your mortgage. Okay, $40,000 is a nice RV. Okay, it's a decent new car. Okay, now I drive I think I drive a Ford. So, so for me, I wouldn't put my 40,000 in there, but this 40,000 is a decent down payment for a house in Saskatchewan or Manitoba. Okay, this is a decent down payment for a small single family in Edmonton. Okay, so you definitely want to consider the effects of increasing your amortization. If you need to do it, absolutely, hands down, consider doing it, but then learn the strategies to pay off your mortgage really quickly. And if you're like, Hong, I don't know what strategy you're talking about, reach out to me. I can help you because I also have this mortgage freedom book. Okay, I actually teach families how to pay off their mortgage in 10 years. Okay, so like a super awesome program. Okay, so the other thing that I want to talk about when it comes to mortgages is this thing about when you switch lenders, you have the potential to save up to 15% or 15 basis points. So what that means is, okay, so what that means is this 5%, instead of 5%, it's actually 5.15. Okay, so what that means is, sorry, the other way, I'm going to go the other way. So instead of 5%, I'm going to actually only be paying 4.85. Okay, so I'm saving 15%, 15% on the rate, or 15 basis point. So that means instead of paying a 5% interest rate, I'm going to be paying 4.85. Okay, so let's see what that looks like. Okay, so there we go. Okay, so 25 years. Okay, holy, okay, so, whoa, okay, let me just back up here. I'm going to go undo, because what I want, okay, so this 566,000 was for the 30-year M. Okay, so I'm going to just put a note so that we know that was for the 30-year M at 5%. Okay, then I'm going to type in 526,268.67. Okay, so usually for this like initial stuff, I wouldn't go to the decimal points, because you know, a dollar here, a dollar there's not a big deal. Okay, but I'm already going down that path of putting in the dollar. So this here is 25-year M at 5%. Okay, so let me see here. I'm just going to put in, can I do that? No, yeah, I can do that, but it's just going to increase the space here. Okay, so I'm just making some dollars here. So the difference here is the 40,000. So I'm going to go and take it from here. Okay, so if I'm at 5%, the difference between the 30 to the 25-year M is a $40,000 savings. Okay, which is huge. Like that is 100% just interest to the bank. Okay, and you never get that money back. It's not like your house had gone up in value by 440,000. Okay, so now let's go back to the 4.85. Okay, so I'm going to change this to 4.85, and let's see what happens here. So now from the 4.85, this number is 509. Okay, so what that means now, I'm going to take this 566,000 minus the 509. That means I'm actually saving $56,000 if I kept it at the 25-year amortization. Okay, so it's almost another, am I reading that right? Like $16,000 in savings there. Okay, so now so it's $16,000 because of going from a 30-year to a 25-year amortization. Okay, so that's why the number is so big. But if I'm just going from like the 25-year stays the same, but I'm just going from a 5% to a 4.85, then the difference is the $526,000 minus the 509,000. That's $16,000 over the course of the life of the mortgage. That's huge. Okay, that for some of us is a couple of nice family vacations. Okay, so that is one way to look at it. The other way to look at it is, okay, so this is 25 years as well, but now we're doing the monthly payment. So it's going to be 4584.76. Okay, so I'm just going to go over here. Sorry, like I don't have a cleaner sheet because I usually don't run this analysis. So the difference here every single month, okay, is $68. So $68 over the course of, you know, like every single month, it's not that big of a deal, like $68, but it does add up over time. Like that's basically $2 a day that you're saving. Okay, like if you're walking down the street and you saw a toonie on the ground, would you pick it up? Okay, I would. Like I'd pick up a penny. Okay, so okay, so if you are able to you know, potentially switch lenders and they're offering you a 15% savings, that's what this is coming down to. So now in terms of an interest, I want to see, look at this. So over a 5-year period between 187,000 to 181,000, that translates to $5,700. Okay. That is a nice family vacation for 2 people somewhere. Okay. For 4 people, maybe, you know, staying in the province. But so over the course of the 5 years, that's what you're saving. Okay. So that is what I've got for you guys today. I do apologize for the technology challenge earlier. So this is another episode of Money Matters on Monday with Hung Lu. This is Monday, October the 21st. Like, this year is going by so super fast. All right. So if you want some help running through your mortgage and trying to figure out, hey, you know what, does it make sense to do this or does it make sense to do that? Feel free to reach out to me. Happy to do that. Okay. So we are on the hour. Thank you everybody for watching. Have a super awesome day, everybody.